Hello, and welcome to our end of January update from the Wealthy Doctor Institute, Intelligent Investing for the Busy Professional. We focus on simple, battle-tested methods of investing that require just one adjustment each month to protect and build wealth. And thanks for all the feedback this past month. Someone made a comment that even with these videos, where I get to point all these things out as explained in real time, I still go quite quickly. And I assume people are up to speed. Now, normally, I just chalk this comment up to the fact that some people have only listened to me a couple of times, but no, this comes from people who have actually sat down next to me while I explain what I do, answering all questions until I thought I was satisfied they understood. I used to think that people who are used to what I do would get bored if I just kept re-explaining what I did. But now I realize it's probably easier for someone to skip ahead than for someone to pause and rewind the video. Me, I prefer to just get to the meat of what to do. That's why I favor investment systems that are both effective and require little time, something important for us busy doctors. That's one reason I try to keep these videos as short as possible. So maybe one thing I can do is to slow down and really explain one concept each month. For instance, this month I've had several people ask me about trailing stop losses. So when I get to the part about trailing stop losses, I'll give you a few examples of how to use it. Normally, most online brokers offer this type of order. If yours does not, you might want to consider another broker. We retail investors have every right to vote with our wallets, and you support brokers who can accommodate us as user-friendly as possible for the least amount of cost. So let's just jump right into our first system, the 20-month moving average system. And again, despite the recent volatility in markets, in the grand scheme of things, when looking at decades of data, the S&P 500 is still comfortably above the 20-month moving average. Still relatively safe to be in stocks. Next. MRI, Monthly Rotation Investment System. Remember, this system is much more different than the 20-month moving average. Don't confuse the two. If you're doing the 20-month moving average, don't do the MRI in the same account, and vice versa. This month, plug in the numbers for last month's price, divide this month's price by last month's price, and voila, the RYURX short fund came out on top, but was pretty much neck and neck with the emerging markets fund. Now, just an aside, I've gotten some questions about what the difference is between an index, a mutual fund, an ETF. An index is just a measure of the overall market, or whatever sector of the market you're monitoring. You can't just buy the index. You can buy individual components of the index. The index just serves as a yardstick to measure how the markets are doing in general, and how you're doing compared to the yardstick. You can, however, buy the index by buying a mutual fund that buys the components of an index. If an index contains 500 stocks, it would be hard for any peon investor like us to buy stocks in enough quantity and in exact ratios to match the index. Buying small shares of a mutual fund that buys the components of an index would be a practical way for us to buy the index. An ETF, or exchange-traded fund, is just a mutual fund that sells its shares directly on the stock exchanges. There are many advantages of ETFs. They keep costs low because they don't have to keep track of how many shares they form or destroy by investors buying or selling a fund, etc. But one big glaring disadvantage of ETFs is because shares are directly bought and sold on the open market. For us to buy and sell ETFs, we have to place trades when the markets are open, if we want to optimize our fills. So, for those of us who have busy schedules during the day, this may be challenging. So, mutual funds are more ideal for calculations. Mutual funds have more years worth of data than ETFs, and mutual funds take into account dividends if you use dividend-corrected data. So, once you use a mutual fund to do the calculation, you trade the corresponding ETF. So getting back to our example, VFINX would be the Vanguard S&P 500 Index Mutual Fund. the one where we got this data for this calculation. And if our system says to trade, we trade the ETF. In this case, the winner of this month is the inverse fund, the RYUYX, so we'd sell the worst fund of the month, the SPY, and buy the best fund, the SH ETF. So if you follow the model strictly, last month you had 1/4 of your portfolio in the RYUX index fund or the SH ETF and 3/4 of your portfolio in the S&P 500 fund. Now we're supposed to sell 1/4 of our portfolio's net worth of the S&P 500 fund and buy the RYURX. So if you're doing ETFs instead, like I do, every time you see RYURX, substitute with SH, and every time you see VFINX, substitute SPY. But this month is easy. Remember, if you have 1 part index and 1 part inverse fund, they cancel out. Since we're half, we can probably save on commissions by just going all cash. We were half cash last month, now we're all cash this month. Something is brewing in Denmark, and the MRI system is telling us there is so much uncertainty, we need another month data to confirm a dominant trend. Exciting times. Dollar cost averaging. Just to remind ourselves, if you haven't contributed to IRA or retirement fund yet, do it. If you're dollar cost averaging for other reasons, stick to your plan. Dollar cost averaging, just like any other plan, only works if you stick with it. And the 1% risk trailing stop. Let's talk about this one, since I've never really gone into this in depth on these update videos yet. I figure I already have it as a blog post and as a book chapter and have gone over it with several of you already one-on-one. But this is important. It's important because us humans, we're creatures of story. We learn best through story, and we evaluate through story. We hear about good stories about stocks, and our natural tendencies are to want to own those stocks. But remember that the markets are often counterintuitive. You may think that a particular stock tip you heard on the news or through your uncle's CEO friend from church is a lottery ticket that will guarantee you a bulletproof retirement and a life of luxury. And yet the data says otherwise. 96% of all stocks since the last 200 years have gone bankrupt or otherwise no longer in existence. In fact, of the 30 original Dow stocks from 1928, only one company is still in the index. Sure, occasionally there will be a Microsoft that will return thousands of percentage points within our lifetimes, but more often than not, stocks will at best match the index if they don't crash and burn. So, what's the 1% in the 1% trailing stop I keep showing you every month? Let's assume you have an account with $100,000. Let's also assume you never want to lose more than 1% on any one stock. 1% is reasonable. 1% loss means you can lose 50 times in a row and still have capital enough to invest. Professional traders consider 2% risky and 3% death wish daredevil risky. A novice will hear a good story on a stock and go whole hog into the stock. Even with a 25% stop loss, the novice will more than likely lose 25%, which requires 33% to break even again. That's tough. A novice could lose 50%, which requires 100% to even break even again. That's really, really tough. So, with a 1% risk on a $100,000 hypothetical account, you never want to risk more than $1,000. Now, 25% trailing stop loss. What's a stop loss? It's an order to sell your stock if your stock goes down below a certain number. So, if you buy a $10 stock and you have a 25% stop loss, you're telling the broker that if the stock drops down to $7.50, you're out. What's a trailing stop? Well, if the stock goes up to $12, 25% down from $12 will be $9. A trailing stop ratchets up the stop loss as the stock makes new highs, decreasing risk and eventually protecting profits. Are stop losses foolproof? Of course not. Stocks can and do gap. In other words, one day they can end up at one price, the next day the opening price may be much higher or lower, depending on what kind of news came out for that stock overnight. So here's a key mathematical equation. How much stock can you buy? If you don't want to lose more than 1% on any one stock, and you're going to let the stock lose up to 25% with a trailing stop loss before getting out, how much stock can you buy with your hypothetical $100,000 account? Most people pause here and then shake their heads, going, this is too hard for me. But I'll give you a shortcut. 4% of your account, or $4,000. If you buy $4,000 of stock and it drops 25%, that's $1,000 and you're out. So let's take a live example. No hypotheticals. Back in 2006, I got a stock tip, a recommendation from a newsletter. Made a great case about how the analyst thought the stock was going up, and so I bought at $37.49. Watch, this is key. Once I bought, I placed a 25% trailing stop loss order. The computer automatically calculated that means the stock ever dropped 25% or down to $28.12, it would sell and I would be out. At the same time, I also calculated how much a 33% gain would be. Why 33%? Think about it. If a stock that has gained 33% subsequently falls 25%, where's the stock? Break even. If a stock falls 25%, how much does the stock have to go up to break even? 33%. So if a stock goes up 33%, then the trailing stop loss has now ratcheted up to the break-even point. There's essentially no more risk. Go ahead and buy more stock at this point. Specifically, use 4% more of your portfolio's worth to buy that stock. So that's what I did. When I bought it again, it was $50.20, which is close enough to $49.97. Remember, stocks fluctuate during the day. And again, when it went 33% higher, I bought at $67.17. And again, I bought again at $89.31. The stock finally peaked at $91.79 and then couldn't go up a penny more and then started to drift down. 25% down from $91.79 was $68.86, which is where I got stopped out. So here's what the stock did afterwards. After I got stopped out, did the stock bounce back up after I got stopped out? Yes, it did. In fact, twice, up to $110. Then it crashed. Way down to less than $10. Do you think the typical investor who bought at $37 would be happy to sell at $68? Would that investor be happy if, after selling $68, the stock went up to $110? What about if the stock crashed to $10? Emotions can be a funny thing. A guy could make money and yet still feel like an idiot. A guy could see the stock crashing, sell at break-even or even at a loss at, say, $20 and feel like a genius when seeing the stock crash further to $10. Emotions and gut reactions would mess up your investment world if not kept in check by some kind of investment system that you decide to employ before you commit your first dollar to the market. Here's another example. There was a medical device that my colleagues saw back in 2004. They didn't know anything about the financials of the company, didn't know anything about the profit margins, didn't know anything except that the company made this amazing device. So they bought in around $30, $40. By the time I heard of them excitedly bragging about it as the stock took off, it was at $70.62. So I bought. My colleagues couldn't believe I was buying the stock when the stock already doubled in price. Yet they kept holding on, thinking the stock was going to keep going up. Funny how when money is on the line, we can hold contradictory thoughts in our mind, yet justify it emotionally. I told my colleagues that yes, I would buy, but I would also respect this 50-day moving average. Of course, they asked me to let them know when I sold. Soon after I bought again at $97.72. When stock peaked soon afterwards, It finally drifted down until it touched the 50-day moving average at $98.12, where it was stopped out. Of course, I told my colleagues. Did they sell? Oh, I think the stock is still going up. This is just a temporary dip. And yes, it was a temporary dip. The stock eventually did go up to $140 a share and then tanked. When the stock was going up, they held on, thinking and hoping the stock was going up. When the stock went down, they held on, hoping the stock would go back up. When the stock went below the purchase price of $30 to $40, they held on, hoping the stock would go back up and break even. Again, emotions can and do destroy our accounts. Battle-proven systems help save your account, but you must follow the system. Now, in this case, I didn't use a 25% stop loss system, but the principle is the same. There's a stop loss that keeps ratcheting up, and because I knew how much I was risking in a trade, I knew how much or how little I could afford to buy and still risk only 1% on my account on any one stock. So again, placing a trailing stop loss order is pretty easy. Yeah. Most online brokers have a variant on how to do this. This particular broker, you go to trade page, go to trade stock. On a trade page, put a stock symbol in, action, sell, put in a quantity, don't leave it blank like how I did here, and advanced orders, trailing stop. Then the trailing stop page, you specify trigger down 25%, good until canceled. Then you press preview order, finalize, and you're in business. So that's it for this month, and until next time, invest safely.